Thursday morning, Chameleon community, and there he is, the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Great. Disclaimers up and ready to be disclaimed.
Okay. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's the disclaimer.
There you
go. So let's get started. And I think what I'll do today is build up on top of our discussion from yesterday. We talked about a little bit about, some of the things I hear from people first starting out trading and kind of looking at trades, or even applying. We talked about the wrong math to the trades and what is a statistical edge. So I kind of just touched upon that. You guys could go back and look at it. And again, this isn't like I'm doing these videos. It's not all comprehensive. I'm just introducing you to the ideas. You could go do all your research on your own, but I'm putting the idea and concept out there kind of for you guys from my own experience. So I think what I'll do is I showed a simple example, heads or tails yesterday, and what is edge. And I'm just going to continue it for a little bit and talk about risk management, because I think it's a big component of trading. It's definitely crucial that you get that right. And I don't think that a lot of people maybe fully understand that, at least like from some of the things that I'm hearing people say to me, or the things that they're emailing to me, makes me feel like maybe they don't really understand risk. Okay. And that is a big problem for people trying to trade stocks or options, that they don't clearly understand risk. They think they do, but not really. So I'm going to give some examples today, but
perfect. Before you get started, just one announcement. Jake is on with First Call right after this show at 10 a.m. Just FYI, just put that link in the YouTube chat if you want to come over Zoom, or it'll just be right on YouTube Live starting at 10 a.m. Thanks, D.
Okay, awesome. So let's start out. We'll start out with the pre-market report. And if you guys have any questions, you can put them right into that chat on the YouTube. Will's monitoring them. He'll read them back to me. If you want to come on live, we put out a Zoom link on that chat. If you click on it, it'll bring you over to Zoom. You could raise your hand. We'll turn you on. We'll be able to hear your question. You could ask it directly. You don't have to turn on your video camera. But those are two ways you could ask. So let's start out with the pre-market report, just so we save some time, and then I'm going to move on to the risk management. Okay. So here, these are stocks trading in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. We see we got 109 stocks that made our percentage gainers list, 75 on the percentage decliners list. So from that perspective, we see a little bit more bullish bias at the open. I'm going to filter these lists by components in the S&P 500 to see if we see a similar situation. So I'm coming up here where the filters are. I'm going to drop this one in ETF. This is a list of different ETFs. The top one, SPY, that's the S&P 500. By selecting that, we're going to filter out by S&P 500 components. So here we see 13 made our percentage gainers list, 3 on the percentage decliners. So more bullish bias at the open. Not a huge list, but nevertheless, more leaning towards the bullish side. So if there are no questions at this point, I'm going to kind of continue what I started yesterday.
Perfect.
Okay. So and when we talked about, risk management, and I did say, look, there are 4 really major components, not all of them, but 4 major components that you need, to have a successful trading operation, or be successful in trading over the long term. And here I'll list it again, just so you guys see it. But education is important. Then you have research, and this is kind of where we come in, Market Chameleon. Then you have risk management, risk management, portfolio management, and then you have your execution system, right? It's how well are you executing your trades and so forth. So, all four have to work together, and you can't just skip over to execution, which is usually kind of what people do, where they'll maybe take, one of these and go to execution. But once you skip any of these, it really doesn't work out well because you're missing something. It's kind of like, you have a restaurant and you have tables and menus, but you don't have a kitchen, or you have a kitchen, but you don't have food, or you have a kitchen and you have food, but you don't have anywhere for the customers to come in and buy it. So all these things kind of have to work together, if you guys catch my drift. So, really we're right here in the research. We kind of try to touch on this so you could, know how to use the tools, but it's not a complete education. We do rely on you. You're going to go and learn. If you're coming to our website, you probably figured out what a call is, what a put is somewhere else, or what a call spread is, put spread. That some of that it is already out there, but the education piece, right? There are other places to do that. Risk management and execution, obviously, also other places to do that. But I just want to touch on the risk management because of the things that I hear. And there are two I separated them into two. One is the initial trade, and then you got a portfolio, right? So you got initial trade, and then you got your ongoing risk. So let's take a look at that initial trade first. All right. So what I did was I created this painting here, right before we got started. I used MS Paint. And I did remember yesterday, if you guys didn't join us yesterday, and we talked about, and I see this a lot, people, we talked about coin flip, right? This is a coin. And we first touched upon, this is what people try to do, is they'll go into this and they'll apply the wrong model or the wrong math. And I see this all the time, even when we're trading on the floor of the exchange. I saw people, come in there, even with PhDs from even Ivy League schools, but they wouldn't kind of get it, in the beginning. What I mean by that is, they'll take a coin flip, right? Something like a coin flip, heads or tails. And what they'll do is apply this math and try to figure out, is the next flip going to be a heads or a tails, right? And that's just a waste of time, right? Because no matter what model you use, and you guys don't believe me, you guys could go read white papers on trading, go read white papers on market making and so forth. They'll give you this advanced math and then they'll say it doesn't work. And they're all over the internet. So what you'll do is just try to, create a prediction model of, is the next coin going to be a heads or tails? And obviously this simple example, we know we can't predict it, right? It's a 50-50. So what I told you was, what do we know? Well, what is edge? Well, if somebody pays us $1.05 because their prediction model thinks heads is going to come out, and they'll say, well, I'm willing to pay you $1.05 if heads comes out, and you pay me $1 if tails comes out. Well, that's a statistical edge, right? There's no guarantee, but if you understand statistics and math, that's a statistical edge. And that's kind of what we're talking about right now, right? Like we're looking for some type of an advantage in the trade. And we stopped kind of there. So if you guys see that, right? Oh, somebody's willing to, pay us $1.05. And I think there's an equal chance of heads or tails coming out, then that's a statistical edge. And as a trader, I might be willing to carry that risk in inventory, right? So there's a risk, but I'm kind of getting compensated or have some advantage of taking that risk. So if there are no questions, let me know if everybody sees that. If not, I'll come back to it. But that's kind of where we stopped off yesterday. So we're all good there, Will?
Yeah, I mean, there is a little bit of delay. If there's anything that pops in, I'll let you know.
Okay. So You know, and that's kind of like where Market Chameleon comes in. It's like trying to get you to sift through the data. And so heads or tails, right? That's pretty easy. You know, there's it's not, it's, you know, it's clearly defined, right? There's two outcomes. There's no, you know, we're not going to flip a coin and see a truck or something else pop up. It's going to be either heads or tails. But in options, obviously, or other things, it's not clear. You know, there's a lot of different variables and factors going into place, and we're using estimates and models to kind of figure out a statistical edge using data. But let's just, for now, just skip, you know, to make it short, let's just say we're playing this game heads or tails, right? And we have these in front of us, and here's where the problem that I see. So some people will say, Dimitri, I don't care about all these, just show me the best one. Okay, that's that's kind of a red flag for me when I hear that, right? Because it's like you don't fully understand risk. So let's just say here's what you see in front of your screen. And I tell you, let me see how many there are. 1, 2, 3, 4, 5, 6, 7. So here, clearly, we're going to agree that heads in each of these cases has a positive expected return in the long term, right? Because if you bet on heads, you know, your payoff is higher than if it lands on tails. So clearly, your expected return here is higher betting on heads. If I told you for today, this is what you're seeing in front of your screen, and you have $7, right? $7 to risk today. And you could do whatever you want with these $7, right? How would people bet on this? So let's put out a poll, right? So you could bet, you know, you could take it all, bet on this one. You could, you know, do half and half, whatever way you want, but you have $7 to risk today, right? How would you allocate that risk? And I'm just trying to see people's mentality. Do you bet it all on, you know, let's just say, you know, do you bet it all on, maybe if I number, you know, how do you do it? I don't know if we could do it in a poll, or like, I'm just trying to see
how do you want the poll to read, D?
Maybe people could just answer, you know, like, do you spread it out equally, right? Do you bet it all on number one? Do you bet it, you know, all on, you know, 1 and 6? Like, I'm just curious to see what people's reaction on, because, you know, I get this a lot where somebody says, well, just show me the best one. That's what I care, you know? So like, and this has to do kind of with the risk management. So on the Market Chameleon, like, just imagine like you found 7 calls, you know, for different stocks, right? And it looks like this kind of, you know, and you think you have a statistical edge. So how would you distribute your you know, your risk? Let's say today.
Well, they are typing it in. Chuck says one on each.
Okay.
Heads only, someone says.
Right. Well, like, it says heads only, but like, would you bet on coin number 1, 2, 3? You know, so these are, before you flip them, right? These are your payoffs, right? So this is before the flip. So you don't know the outcome yet. Just like when you buy a stock or an option, you don't know the future outcome. But this is kind of like.
So with the question, do you bet all on one of the 10?
Bet all on one. Do you spread it out? Do you bet on 1 and 6? Like, I'm just curious what people would say.
100% were no, they would not bet all on one.
Okay, so you see, so when I lay it out to you guys, and that's good. And I like your thinking, people are thinking, because I'm walking you through it. That's why it doesn't make sense, you know, when I hear Dimitri, just show me the best one. Well, what does that mean, the best one? You know, like, are you saying that because are you implying this is all you would want to see? And if you have $7, you're just going to go all in on this. So here you're starting to understand kind of risk management, that even though, yes, this one pays higher than this one, but if all of these have a positive expected return, you're willing to take that average for that diversification, right? Because you're going to win some, you're going to lose some, but if you have some kind of an edge, then in the long term, you should come out with positive expected returns. Okay. So, and remember, edge is not just kind of this alone. It's also how you're managing your risk and adjusting stuff. But let's just stick with this example. This is a simplified example, but just to make things more clear. So you'd say people would evenly distribute, right?
That's what they're saying. Yep.
Okay. So that's pretty good. Now, let's say I change this up a little bit. And remember, like when I'm saying risk $7 for today, I'm not saying you have $7 in your account, right? I'm just saying like maybe you have, $250, right? Something like that, right? So even this alone on today you should not be going all in, right? You shouldn't be doing this. You should be saying, this is kind of what I want to risk today, and see what happens. So let me ask you this. When you do it with, how many of you, if you saw this, does it make sense to you guys, now that we're looking at it, to say, I'm going to take $1, and I'm going to say, okay, this one looks good, 105. So I'm not going to bet $7 equally here. I'm going to take $1. Bet it here, right? I'm going to bet it on this instead of all 7. And then I'm going to wait and see what happens. And if I lose this $1, this is what I see. I just want to see how this plays out. So if I lose this $1, this is going to indicate to me this doesn't work, right? So this means, it doesn't even work. So why should I bet the other 6? Because that means that doesn't work. Does that make sense to anybody to do that? How many people think it makes sense to just say, okay, out of the 7, I'm just gonna do this one and see how it plays out. So we'll see. I mean, it's a little bit of a delay, but I'm just when you have this in front of you, sometimes when you have the picture in front of you, it makes more sense than when you're initially looking at it in your mind. So the question again, and this is what I see people do. Oh, you know what? Okay, but I don't want to bet on all 7. I just want to bet.
We got a couple no's. Is what we got.
Exactly, because you can see here that.
Hey D, your mic is just taking you underwater. You become a sea chameleon. Do you want to log out and come back in?
Yeah, let's try to do that. Right. Okay. So we get a bunch of no's, right?
I can't hear you. No.
All right, log out.
All right. Well, Dimitri logs out. A couple house cleaning issues. Monday we have a webinar with who's that? With Felix Fraze coming on Monday, and that's at 6 p.m. Monday night. I will put a link into the Zoom and the YouTube. Right after this show, we have First Call with Jake, aka the Doctor. He'll be coming on and talking. I think he's going to end his Greeks and maybe discuss a little bit about his use of the chameleon, looking for ideas. Mike Monroe, sorry I missed your message, Chuck. Oh, Mike's popping it in. And then for everyone who's in the chat, thanks for participating. It's a big deal and makes it worthwhile getting up every day and doing this show. It's much appreciated. Let me grab the link for Jake's show for those who haven't seen it.
Will, do you hear me?
I do. You're back.
I'm back. Should I share my screen?
Yep.
Okay. So so what I'm showing you now. So I think a lot of people said no. So I think that's good. And that's why when I hear, show me the best one, it sounds to you, right? It sounds to you or to the person that's not familiar with stuff, it sounds logical. But to me, it sounds illogical, right? When somebody says it, and I'm trying to display why. So show me the best one, or, I will try one and see how, it works, right? So you see how, like, when people make these statements, I feel like they don't quite understand risk, like what you're trading, what's going on here, right? Like, and it's important to understand risk because then you'll be able to trade it better, you'll be able to manage it better, navigate it better. And when I hear statements like this, it's kind of a red flag. Well, what do you mean show me the best? So are you saying, we just did this example, are you saying you just want to see this, and that's it? And then are you going all in? Or what do you mean you'll just try one? Are you just going to pick one of these and do one? It's the same thing, right? Because then you're just talking about you're not really understanding risk, right? You're not really understanding it. So that's one example I wanted to show, and I think people are getting it. I think that we're getting pretty good answers. Let me take this away. What if I change this up? What if I change this up and I change this one and I said, for today you're risking $7. What if I change this payoff to $20? What would people do then? Would you still diversify evenly? Would you bet it all on one, or would you put more weight on one? What would you do? So so distribute it evenly, right? Just like we did before. Do you put it all on one at this point because it's clearly $20 instead of $1.03, or do you put more weight on one? And right now, let's just pretend that that it's a fair game, right? Like it's a fair game. There's no insider or whatever. Let's just pretend that. So what would you do?
All right, let us know what you'll do, everyone. If the amount you're going to potentially take in if you win has been increased to $20, will you
$20, right?
More money to it? Will you?
So and here's the point. What I want to make is that there are going to be times. There are going to be times from your experience that you're going to start varying your bets. So we just put one where it's all evenly distributed. And I agree, I would evenly distribute it because they're all pretty similar, and I'd rather have that diversification and take that average than try to put it all in one. But there will be times when I'm showing, and from your experience, you're going to recognize something that says, hey, I should be varying my bets and maybe perhaps putting more on one bet because now it looks good.
Well, we have one still even. One will put more weight on the first one, and another will put more weight. So those are kind of the feedback.
The more weight, right? So that's the kind of the idea is, and I did an extreme one here. So there are going to be times where you're like, hey, wait a minute, this kind of looks good. I might actually do more. And from your experience, you will see that because you've already seen certain situations play out, and you're used to a certain stock, you're used to a certain implied volatility, and kind of like, hey, I've seen people oversell something, after earnings, and I should probably buy more because this got. So yes, there are going to be times where you're going to want to change. You're not evenly distributing, but you're going to start changing your weighting, right? But if you see this, let's say you do see this, and we're not sure if it's a fair game, right? This actually is not, sometimes might not be when we say the best one, this might be actually a red flag, right? So, because if you're looking
Actually,
at this, other people are.
Actually,
Huh?
John Miller said caution.
Exactly. There we
It could
go.
be a red
So there are
flag.
people there now you've gotten that experience. Anybody ever, and I'm sure like if you got a lot of you I know have been trading for a while. Anybody ever like see a high dividend stock and you're like, hey, wait a minute, this stock fell. It's paying 11%. It looks really good. Then you buy the stock, you think, oh, I'm going to yield 11%. And then all of a sudden, the stock keeps going down. And like 2 quarters later, they cut the dividend almost every time, right? Because all of a sudden you're seeing a red flag. What's going on here? Like, why is this way out of proportion or out of line? That's when you kind of want to say, whoa, caution, right? So sometimes the best one is giving you actually a contrary signal. Okay. It's probably might be telling you something that in the opposite direct, because maybe this heads and tails something here is off base. Maybe this coin is not fair, it's chipped, whatever, but something might be going on. So that's another caution when you're looking kind of for the best one, right? So do people get that? Do people understand it? And that's where you have to then actually pay more attention and do more research. Okay, so I know we're in a little delay. I'll just keep going, but tell me if there are questions, right? So this one,
Perfect.
you got to play with caution. Huh?
No, I
You
got
might
you.
even skip this one if you don't understand it and go to these, right? But you definitely want to like go in there and pay attention to what's going, like why is this lining up this way. Now look, I'm going to go back here. Let's just put it back to 105. I don't have a lot of time. Do people like this, by the way? I mean, I could go back to the market community, but let's see. Tell me if people like it or they want to just go back to the tools. So I'm going to go back to the 105. And let's say we go back to the original bet, and we say we evenly distributed, we bet on all 7. So that's the initial risk, right? But I'm going to flip this and say like, well, what if these were all calls? The heads and the tails were all puts. So at this point, and you have like whatever, 2 weeks to go, 3 months to go, now you're holding a bunch of calls, right? Well, besides your initial risk, now you got this carry risk. So what you're actually doing is you diversify your risk because let's say these are all different stocks, but now you have some risk in common, right? So if all these are calls, if all these are calls, right, and all these are puts, but you put them all in the calls because they popped up as good ones, and maybe you like the stocks and so forth. But now what are you carrying? Do you see you diversified about what type of risk are you carrying? Does anybody know? Like if all 7 of them are calls? And this goes into portfolio management, right? So remember we talked about 2 different risks. One is your initial risk when you put the trade on, right? And then you got this portfolio management risk because now I'm carrying this portfolio. So if you're doing all calls, right? What do you got?
If you're buying all calls, you're saying.
Right. You're buying all calls, even though they're diversified. Let's say whatever it is, Amazon, Tesla, Netflix, whatever. Let's say they're all diversified. But then you have another exposure now, right? Now you got market risk because even though you have different stocks. If all you do is have calls and the market goes down, you've got that market risk. It's going to impact them all, right? Like if the whole market is just collapsing, it's going to weigh in, right? Because they all have some exposure to market risk. What else you have? You got probably Vega risk on, right? Because you've bought all of them. So now you have, if the market just sits there, you're going to start decaying. So then what you have is this ongoing risk that you got to manage and be like, well, maybe if I'm afraid of the market going down, maybe I find somewhere where I could buy a put even at fair value. So at some point you might actually be okay. Now heads or tails, remember these are, I'm changing because all heads and tails, one spin has nothing to do with the other, right? But options, they're not the same, right? You got these other risks in place where the stocks, maybe Amazon and Google, they're separate companies, but if the market's going down, if everything's going down, they're going to get pulled down too. So they have that in common, right? And that's what we mean about portfolio risk. So we talked about two different risks. It's at 9:30, initial trade, right? That's what we looked at. Then you got this ongoing risk because now you did all these trades. Now you got a position, you got a portfolio now of risk. How do you manage that?
Well, that was an awesome webinar, D. That was great. Everyone was super happy with that. Thank you.
All right. Well, thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
And please join the doctor and myself at 10 a.m. for his first